Now there is a question relating to calculation of GST liability and government revenue therefrom. A makes interstate supply of goods valued rupees 50,000 to B within the state of Karnataka. That means here A and B both are situated in the state of Karnataka. So the sales are made on interstate basis. B makes interstate supply to X Limited located in Telangana after adding 10% as his margin. Now there is a chain. A makes sale of goods to B, but this sale is within state, that is Karnataka to Karnataka. Now B makes sale to X Limited. Here state of supply is Karnataka, but here B makes interstate supply of the goods to X Limited. So here the sale are made on interstate basis because location of the supplier is Karnataka and place of supply is Telangana. So here the sale are made on interstate basis, and these sale are made after adding 10% of the margin of B. Thereafter X sells it to Y in Telangana, that is interstate, after adding 10% as its margin. So here A makes sale of goods to B. Here A and B both belong from Karnataka. So it is a intrastate sale. Now B makes sales to X Limited. Now X Limited belong in Telangana. So second sale is being treated as interstate sale. First sale is intrastate sale, Karnataka to Karnataka. Here location of the supplier and place of supply are in the same state, so it is a intrastate sale. B makes sales to X Limited. Here location of the supplier is Karnataka, but place of supply is Telangana, so it is a interstate sale. Now X Limited again makes sale to the goods to Y. Here location of the Y is in Telangana. So the final sale is made to Telangana from Telangana. That means here location of the supplier is Telangana, place of supply is also is Telangana. So it is a intrastate sale, and Y is the final consumer of the product. So I repeat again, first sale is the intrastate sale because location of the supplier and place of supply belong in the same state, so it is a intrastate sale. So for this sale CGST and SGST is to be applicable. B makes sales to X Limited. Here location of the supplier is Karnataka, but place of supply is Telangana, so it is a interstate sale. So here the output tax will be in the form of IGST, because when the sale are made from one state to another state, there will be IGST which is to be collected by the central government. Again X Limited makes sell the goods to Y, and these sale are made in Telangana. So here the location of the supplier and place of supply belong in the same state, so it is a intrastate sale. So again the output tax will be in the form of CGST and SGST. Now here the first sale is to be taken as the first cell is to be taken as intrastate cell, second cell is to be taken as, here the second cell, and this cell is to be treated as interstate cell, and the final cell, that is the third cell, this is the third cell, it is to be treated as intrastate cell. For first cell, that is for intrastate cell from Karnataka to Karnataka, there will be CGST plus SGST. Output tax will be in the form of CGST and SGST. For second cell, since it is a interstate cell, output tax should be in the form of IGST. The third cell is the interstate cell, so here output tax will be in the form of CGST plus SGST. Now here first cell is made by A of Karnataka to B of Karnataka. Now here the sale price is rupees 50,000. Since it is a intrastate cell, here here CGST and SGST will be applicable. Since the rate of GST is 18%, here the CGST and SGST is to be segregated at 9% and 9%, that is equal segregation is to be made between CGST and SGST. So CGST will be 4,500 and SGST will be 4,500 and total will be 59,000. This is the total price charged by A from B for intrastate sale of supply of the goods. So here the total bill amounts to rupees 59,000, which comprises of CGST of rupees 4,500 and SGST of rupees 4,500. Since this is the first sale, there will be no input tax credit, because here A making sale of goods to B, but A does not making purchase of input from anyone. A making the first sale. So here there will be no input tax credit that is to be available in the hands of A. Now next, here B makes supply of goods from Karnataka to X Limited of Telangana. Here the goods are sold from Karnataka to Telangana, so it is a interstate sale, and here the sale is made by adding 10% margin. Now since it is a interstate sale, here the output tax will be in the form of IGST, because we know that when the sale are made from one state to another state, the GST will be in the form of IGST, which is to be collected by the central government. Now here the sale price will be 50,000 plus 10%, because margin of 10% is there. So the value charged for the supply of goods will be 55,000 and 18% IGST will be on there, and the amount of IGST comes to 9,900. So the total price charged by B from X Limited for interstate supply of the goods is rupees 64,900. It is the total amount of the bill, which includes rupees 9,900 as IGST. Now here the output tax of B, that means the supplier, is in the form of IGST of rupees 9,900. Now B making purchase of goods, such goods from A, and at the time of the purchase of these goods, B paid CGST of rupees 4,500 and SGST of rupees 4,500 to A. So here B can avail the input tax credit in respect of the duty, in respect of the GST that is being paid by him at the time of purchase of such goods from A. So here output tax of B is in the form of IGST, which is 9,900, from which he can avail the input tax credit, benefit of input tax credit, first in the form of CGST of rupees 4,500 and then in the form of SGST in the form of rupees 5,000. So here output tax of B is rupees 9,900, which is collected by B from X Limited. This is the output tax from which he can take the benefit of input tax credit for GST that is being paid by B at the time of purchase of goods from A. Here it is a net tax payable in the hands of B will be output tax is 9,900. First he will take the benefit of input tax credit. Here first credit is to be attained by him is SGST. This is the first credit that is to be taken by B, because both IGST and CGST are collected by the central government. So at the time of availing the input tax credit, first CGST is to be adjusted and then he will take the credit of SGST against the output tax of IGST, and net IGST payable to the central government comes to rupees 900, and this amount is to be paid by B to the account of the central government for addition in the value of goods.